Hello and welcome to The Market Lens. I'm Sam Rozzi, the manager of Due Diligence at American Portfolios, and I'm joined here by Cliff Walsh, our Chief Investment Officer. If you haven't checked out our previous Market Lens videos, please do so at Studio 454 or YouTube. Today we'll be starting with a news or noise segment on the Johnson & Johnson vaccine pause. Out of an abundance of caution, the Johnson & Johnson vaccine rollout has been paused in the U.S. due to development of a blood clotting condition called CVST, which does not allow blood to properly drain out of the brain. Health organizations have also observed this condition in a very small number of patients that have received the AstraZeneca vaccine. Do you believe this vaccine hiccup is news or noise?
I think right now, in the grand scheme of things, I think it's noise here in the U.S. It's a short pause, and it's an extremely rare problem. It's a 10-day delay, as they wait and see what the data looks like from the past 2 weeks of vaccinations. So right now, I think it's a speed bump on timing. Not to mention, over 7 million people have actually had the vaccine. Only 6 people, as of this taping, have gotten, the condition. So it's 0.0001%. It's terrible that it's happened to even that many people, but we have to put this in perspective. It's a ridiculously small number. From a distribution standpoint, maybe a little bit of a bigger impact, but still, not that much of an issue. About 9 million J&J doses have been shipped out to the states that are going to be delayed. It's going to create a little bit of an issue, but I don't think it's serious at this point. 28 million doses of Moderna and Pfizer have been shipped out in the past week, which covers 8% of the U.S. population in 1 week shipment.
Okay, so what happens if the data that they gather in the next 2 weeks goes bad? Right now, it seems like this is a 1 in a million type of issue, but what if more cases are observed? Is this the worst case if this also spills over to the AstraZeneca side as well? Do you think that's possible?
Yeah, so I think there's a couple of issues here. I think if they have issues with the data starts coming back bad, I think you could see a longer pause as they assess more data. You could see Johnson & Johnson get pulled, which would be an issue as well. And this would come at a pretty bad time when cases are rising and when states and the government in general are dealing with vaccine hesitation. Certainly that would only add to it. So it would definitely delay reopening efforts. The company also said, and Johnson & Johnson said it would be looking at adding a second dose to what they had approved in February, which was 1 dose. That could certainly add some complexity or distribution issues as we push out to herd immunity and the reopening.
Okay, so it's noise here in the U.S., but what do you think the implications are for Europe?
There, I think it's more news. I think all of the EU countries were offered allocations of the 4 main vaccines: AstraZeneca, Johnson & Johnson, Pfizer, and Moderna. Many opted to forgo all or part of their share of the more expensive or more cumbersome vaccines like Pfizer and Moderna instead of the AstraZeneca and Johnson & Johnson. So now they have less cushion because they're relying on it more. 55 million doses of Johnson & Johnson were expected by the end of June, 120 million more by the end of the year. That could really put a dent in things. Not to mention both Johnson & Johnson, as you mentioned, with AstraZeneca, they both have the same issue with relating to this, blood clotting condition. So if both had issues and both got pulled, I think, Europe is in a really tough spot here. When you look at the U.S., Johnson & Johnson was our third option. AstraZeneca hasn't even applied for FDA approval, so it wouldn't be as big of an issue here. But globally, those 2 players, make up the bulk of the market share. So internationally, I think the markets would be hit pretty hard if this issue does have more lasting effects.
Yeah, this is a very interesting issue, and we'll definitely keep tabs on this moving forward. Now we'll zoom into the market lens for today, which is going to be the story of growth versus value. We've constantly been discussing the value versus growth argument, and we've seen growth lose some steam here in 2021. Large cap growth hit its high versus large cap value in September of 2020 when it was outperforming value on a 3-year time frame by 64%. Now, as we film this, large cap growth is up around 47%. Do you think growth will continue to lose some ground here versus value?
Yeah, look, I think value will continue to outperform in the medium term, but I do think there are going to be more fits and starts, in the short term. But there are a couple of reasons why I still like value. Value is an ongoing beneficiary of higher long-term rates and the steepening of the yield curve. it doesn't just outperform when the yield curve actually steepens. It should have lasting effects as the curve remains steep. Banks lend money and they make a lot more money for as long as the curve is steep, which fuels expansion in many cyclical industries. Value also remains an outsized beneficiary of reopening, which is still in its early stages. We also have the rebalance of equity, quant, momentum baskets, and risk premia products, which should continue to support value throughout the second quarter here. And finally, value remains the most attractive style versus history.
Right now, growth fundamentals are well above their 20-year averages across all style boxes. Large cap growth is trading at 169% versus its 20-year average PE. Mid cap growth is trading at 190% versus 20-year average PE. And small cap growth is trading at 246% versus its 20-year average PE. While all areas of the market are pretty overheated here, do you think these fundamentals will continue?
I don't think it'll continue. I think it's a problem for the market as a whole. I think you have to be invested, but you have to look at the relative values out there, and that's in the cyclical or multiple stocks, but I think you have to be selective. I would certainly stay away from those high multiple stocks with extremely high aggressive growth factored in. I heard someone say the other day that growth investors have to put the ARP back in GARP, meaning growth at a reasonable price. I think it's a stock picker's market, and I think growth investors can do okay if they are thoughtful about their approach, and avoid those stocks with the highest expectations. But I do not believe that we are in a market where a rising tide is going to lift all boats. I think it's close to high tide.
Okay. What would happen for the value trade not to work here?
I think if U.S. Treasury rates rally really hard, you could see growth regain leadership. Basically what happens is those long-term earning streams of those growth companies get valued very nicely with low rates. I think to a lesser extent, if you see the opening of the economy stall, earnings growth could become more scarce, and you're going to see those secular growers over the cyclical players. For value stocks, it's been a decent run already, and the wind is at their back for now. Should the reopening surge fade quickly as stimulus fades, it could be a speed bump for those cyclical value plays. You mentioned the gap between growth and value. It has narrowed. I think it can continue to narrow, but as it gets closer, obviously the trade becomes less and less exciting, but I don't think we're at that point just yet.
Yeah, the growth versus value argument has been going on for a very long time, and I'm excited to continue tracking this, and thank you for your insight there. We thank everyone who joined us for this Market Lens, and we hope if you missed any videos prior that you will check them out on Studio 454. But with that, we hope that this Market Lens is helping you see 2020. Thank you, and we hope to see you soon.